Hi, Grant Soliven here with the Financial Enhancement Group, Accredited Investment Fiduciary. Welcome you back. We're on week 3 right now of the series that Aaron and I started, where we're talking through the critical elements that we work through when planning with our families and friends. Today is the second aspect of that series where we're talking about tax planning. I'll be very upfront with you, there's a lot to cover in this, and this is the bread and butter of what we do. So in order to try to get through every bit of tax planning we possibly can hammer out with the family, it's going to take a multiple video series to cover, and we will do that over time. But today we just want to focus on the general concepts of why it's important and what you should be thinking about in each phase of finance. We've covered phases of finances before, and Aaron's our Director of Financial Planning, who's with me today. Like always, he's a great resource, great leader, and really phenomenal at planning. He's going to walk us through the answers to those questions. Before we get into that, you're probably thinking, Grant, where's that disclosure? Here it is. So naturally, we want to make sure that you know that we are SEC registered. What that means is we take care of families. We have over $400 million of assets we manage for over 1,000 families in 30 different states. We are obligated and by law required to make sure we treat your money the way it would be treated if we were in your position and had the same assets. So we want to make sure it's always there. We need to cover that for compliance, but also so you know that we are fiduciaries and we take that very seriously. So with that being said, Aaron, thank you so much for being on these calls and these recordings. You're such a wonderful asset to our team and to our families. So I'm going to be up front. I'm going to hit you with it. You know it's coming. So we're in tax planning, a critical element that we take very seriously. So walk us through, why is it important? Why should we consider tax planning when investing resources and when approaching savings as a whole?
Great question, Grant. And tax planning is probably one of my favorite of the 5 critical elements, if not the favorite. And so, you know, when we sit down with families, Grant, holistically, if you're not focused on tax planning and your retirement planning together, or what we like to call your life after work, then you're actually doing a disservice to yourself. So if you're not working with someone that has taxes or tax planning inside of their business model, we encourage you to reach out to us, because you're probably doing maybe something wrong, but we would, again, encourage you just to reach out. So on the tax planning side, Grant, there's multiple things that we can focus on. As you mentioned in the opening part of the video, we can go in so many different directions and create just a whole series on this, and we will. But really, just to boil it down to, as you mentioned, the phases of finance that we talked about, you know, in accumulation, what really matters there is making sure you're building a diversification of your assets and saving the right percentage of money. And what I mean by that is, should you contribute to a Roth IRA versus a traditional IRA? Or should you contribute to the tax-deferred side of your 401k versus the Roth side if you have that as an option? Why that matters is, you know, people get advice from you know, their family, their friends, and ultimately they have most people's best interest at heart. But let's walk through a scenario. So let's say, you know, in that accumulation phase, you're just starting off, you graduated from college, you have your first job, you're making an income, and the way we look at it is, where do you fall on that scale of taxable income? And so everybody pays tax at different levels based on how much money you make. Most people think they pay tax on their adjusted gross income, which is also AGI. That's not the case. You pay tax on what's called your taxable income, and that is based off your deductions, which could be itemized. So if you're writing off mortgage interest and charitable giving, or a standard deduction. For a single filer this year, that's $12,400. For a married couple, that's $24,800. And if you're over 65, you get some additional benefits. So as I'm walking through that, going back to the accumulation phase, let's, you know, go back to that job scenario. You're first starting out and you're married, so your taxable income is in a 12% bracket, which for a married couple is $80,000 of taxable income. If I had the ability to contribute to a Roth in that 12% bracket, I probably would not defer tax at a 12% rate. I would contribute to the Roth IRA, contribute to the Roth 401k. Odds are over time, your income is going to increase. And then it starts to make sense to start tax deferring assets when you get into those higher brackets, like the 22% or 24%, all the way up to 37%. I know that was very, very long-winded. I don't know if it may or may not have made sense, but at least in the accumulation phase, you really want to make sure what type of accounts you're contributing to, building tax diversification through that. And so, did that answer your question, Grant?
It does. And when we get into preservation and distribution, as Aaron's saying, there's so many other aspects that you need to consider, because most of our families have ESOP programs or restricted stock units, options, and then a lot of times we're asked, should we do Roth conversions? How does that work? And something that needs to be said, Aaron, I think you would completely agree with me on this, is taxes are not easy. We think they are because we hand all of our stuff to a tax reporter, a CPA, a tax preparer, H&R Block, somebody, right? And they do our taxes, they hand us back and tell us we owe or we don't owe. And when we get a refund, we feel good, but we'd never ask the questions of how things work. So part of what we do and part of how we help our families is we get into the minutia of how things function. So when you have questions like, why do I owe this money? Well, we're not going to leave you hanging on why you owe that. You're going to understand through a process why we do what we do. And like Aaron said, folks, it's really important to understand how significant taxes are to your overall plan. We'll be creating content to kind of walk through more phases and more ideas and what we do with families on a more detailed basis later on. We're trying to get through the overall direct planning. That's how it works. And remember, Aaron said this earlier, if your advisor is not asking for your tax return in every meeting, we implore you to go and find someone that understands it, has the resources and knowledge, and the right team. Aaron and I are not CPAs. We will not play CPAs on these calls or recordings. But you do need to work with someone who is in conjunction with someone like a CPA who understands planning to help you make all these strategies and efficiencies come into fruition. Tax planning versus tax reporting is significant. We are planners. We are not reporters. And we want all of our families and friends we work with to be planners. So thank you for being on this with us. Really, it's going to be a joy as we go through these in more depth throughout the year. And Aaron, I just can't thank you enough for being here. Your wisdom and your ability to kind of work through content like this is one of the reasons why our team is so successful. And some of you also know our managing partner, Joe Clark, kind of at the helm of that ship. He's trained a lot of us very well. So if you have questions, please reach out to us at yourlifeafterwork.com. You can also call us at 800-928-4001. We hope you have a wonderful day and stay safe and healthy.